Good morning. Welcome to Trading with Larry. Larry unfortunately can't make it today, but we're joined by Clint Brewer, who is Larry's analyst, and I'm Eric Shamilov. How are you, Clint? Good morning.
Good, good. It's good to be on the show again.
So, war headlines, the number one thing that is affecting the market. What do you think? Oil, is it just as simple as follow oil? If oil falls, the market is going to fall, because that's what it's been over the weekend. As soon as the market opened up, the futures market opened up last night, it became pretty clear that the market kind of wasn't afraid anymore. And, we're sitting here inches away from an all-time high. We have all these ominous headlines in the Middle East. We have a broken tariff narrative, which may come into play a little bit later on in the year. But right now, it's just a headline-driven market, and all the narratives associated with these headlines seem to be false. Am I getting this right?
Yeah, pick your narrative. No, I think if you wanna understand the narrative, I think you got to look beyond the headlines and look at how certain markets are trading. And I think there's been some really interesting developments over the last week or so. Obviously including what happened with equities on Friday, steep sell-off, and the spike in oil. Yeah, I mean, you didn't see the reaction you would have thought when as futures kind of settled down when they opened last night. We had, despite kind of things still being unresolved over the weekend in the Middle East, you had equities coming off their worst levels and starting to rally, and you had oil starting to pull back. I think if you're a short-term reversal trader, you're maybe looking for some of those signs that just very near term, some of these moves got stretched too far, maybe especially in the oil space. I mean, that was, I'm looking at the chart of oil right now. I mean, we had a completion of a pretty bearish setup when oil broke below that 65, $66 level back in April. And then, I mean, it looks like a failed breakdown because you had that massive move back higher, which, Larry, I mean, he was talking about looking for an opportunity to get long oil before that happened. So, you're seeing a reversal of some of those. And I guess, I think maybe the market, what it's telling you is that the worst has been spared so far from an economy and stock market standpoint, and that you're not seeing a major disruption in oil supplies just yet. But I think it's kind of
Yeah,
interesting though.
yeah. And it's all about just yet. It's all about the Strait of Hormuz and whether they're gonna close that up and whether
Right.
Israel is going to bomb some of their refineries. So far, the market is kind of optimistic, right?
Well, here's something to maybe think about, because I saw this chart over the weekend. We heading into this event, we had the U.S. China tariff headlines. There's this framework in place, but that you could tell where China is exercising a lot of its leverage is in that rare earth metals space that they control so much of. Well, I can't remember the number, but the vast majority of Iran's oil goes to China.
Correct.
I mean, you're just wondering if behind the scenes the Trump administration's looking for a way to, I don't know. I'm just saying, is
Well,
there some
yeah,
leverage?
it's interesting. It's interesting you mentioned that. I'm glad you did. Larry and I talk about tariffs. Larry obviously thinks the whole tariff thing is complete nonsense. All of these deals, and I keep saying, well, maybe, just maybe, some of these economies can open up a little bit to U.S. industries, energy being one of them. We have a lot of oil, and I understand some of the refineries aren't set up to process our WTI, but we have LNG, and those refineries can be refitted, right? So, is that what you're alluding to? Maybe behind the scenes, we get a little trade deal action on the energy side.
Well, I mean, maybe just that, yeah, potentially, or that the way that China's using its control of the rare earth market to as a point of leverage for them. Is now all this uncertain? We're as a key ally for Israel. Is there some leverage that we're trying to put on the oil supply side with China? Is that a point of leverage that they're looking for? Um, I don't know. Well, who knows? But we'll, obviously it's a fluid situation. Things are going. But I wanted to ask you really quick just about, you mentioned the opportunity in energy markets. That's something else I've been thinking about a little bit. Is that you look at the I saw a stat over the weekend. You look at the energy sector as a percent of the S&P 500, it's only 3%. So like it's weighting in the S&P is 3%, and that's the second lowest level in the past 100 years. It has the lowest forward PE ratio of any sector in the S&P. It's like 14 and a half times earnings over the next 12 months. Is there, if you get energy prices, staying high here, or like you kind of alluded to, is there a play for the U.S. to take a bigger role in supplying energy on the world stage? Do those two kind of demand features? Is there an opportunity in energy? Maybe if you have a longer term horizon.
Yeah, I think so. We have, you go back to the Russia Ukraine war when that started, and how Russia basically cut off gas supplies to Europe, and they were scrambling to find an energy source, and LNG prices started to go up. So that's fresh in everyone's mind. The problem is capacity. Um, Setting up the terminals, not just to export it, but once you get it there to deliquefy natural gas. There's a lot of, I think, inefficiency in in the global energy markets, that, if it could be solved, I think the U.S. would be a huge benefactor of that. So I'm hoping for that. That's why I keep, I'm keeping a long term view on stocks like LNG, Cheniere. Um, these global, and this is our LNG producer. I think it produces almost, if I'm not mistaken, a little bit more than 10% of global LNG supply. So if China would open up its door, if Japan, all these countries that use LNG, if Trump could could get them to open up the door to our energy industry, I think it would be tremendous. So yeah, to answer your question, yeah.
What do you think about maybe two things? One, you've not really seen the move in natural gas like you have in oil prices after everything that started happening late last week. I mean, are they? I don't know a ton about the energy landscape. If they're just not a big, Iran's not a big producer of natural gas, or is there not just much of a threat of a supply disruption there?
Yeah, our natural gas, the headline Henry Hub, on that people reference, which is, it's a very uh, idiosyncratic domestic market. Like natural gas in Europe, natural gas here,
Okay.
prices are going to be different and move to the beat of their own rhythm, right? It's completely different domestic market. Whereas oil, because it could be exported more easily than natural gas, you're going to have more of a correlation. So I wasn't really expecting natural gas to really move on the news. I know it's been going up a little bit. It's really just oil. And I think whenever there's a war, especially in the Middle East, everybody kind of references the Gulf War period in 1990. So I'm just going to pull up a chart, which you see here. This is WTI in 1990 as the Gulf War started. Right. So what you see there is straight up. There was never really um, a pullback. And the pullback that you do see here, this is just the result of the futures roll, but crude oil prices just went straight up. Um, you kind of you look at where oil prices are right now. I would be looking there and saying, well, if we're gonna break lower, if we break lower in oil, then I mean the market just pretty much has a green light for new highs, in my view. So I would be just watching oil, and everybody wants to reference the Gulf War in 1990. That thing just went straight up. There was no real pullback. So any kind of pullback in oil, I think, would kind of render this whole fear in the Middle East kind of almost moot.
Yeah, it's a good point. I was just pulling up a Fred chart of CPI from back then. What's interesting is that CPI, the year-over-year change in CPI, it peaked out in October 1990. So I'm not sure what that time frame was you're looking at on the oil chart, but it peaked out in October 1990 at 6.3% and then proceeded to fall pretty much over the next year or so down to 3%. So I mean, yeah, I mean that's I'd kind of look at the inflation impact, maybe that if oil prices stay elevated here or not, and what that's going to do for the outlook, and just the if that could pressure valuations.
Look, that inflation report that we had last time a couple weeks ago in CPI came in soft. PPI came in soft. We had two CPI reports in a row that came in soft. I think there's a high probability that that was probably the last soft inflation print we see for a while.
Yeah,
CPI kind of lags commodities, and obviously commodities have been flying. So and there's a lag effect. CPI lags from what I've seen, lags commodity prices by about a 3 to 6 month period. Back in 2022, when everybody was afraid of inflation, uh, commodities peaked out way before everyone realized we were heading into disinflation in 2022, right before the big rally at the end of the year that set us off on a 2 year bull market. So, yeah, commodities underneath the surface kind of you got to watch it, and I think right now is the time.
yeah, I think so. If there's one chart I'm going to watch more closely than any other chart right now, it is going to be there's a number of them, but a broad commodity index. I don't know if you have like the S&P GSCI that you can pull up, or the GSG is a ticker, is an ETF that tracks that index. But you look at a to your point, if you look at a broad commodity index, it had the huge run in 2020 and 2021, and then for the last, I don't know, 3 years, like this thing's just going absolutely nowhere. I mean, it's been in a range. It's traded in a range, and last week with the bump in oil, this thing's close to breaking out of that multi-year range, and that just to me that has a that's just a major tell on what inflation's going to do here down the road if you start to see that moving higher. Yeah, so if you can go back to like say 2020 on that chart.
Yeah, so this is a total return. This includes the effect of the roll.
Yeah.
Yeah, we've been pretty range bound, but
So to
kind of
your
moving.
yeah,
Yeah,
so your point, so when you look at that chart, the inflation that we had kind of post pandemic, post COVID, and all that stimulus, we had inflation peak. The year over year change in CPI peaked in the middle of 2022, which no coincidence. That's where this index, this S&P GSCI index, it peaked out in the middle of 2022, and it's just been grinding sideways ever since as we've had this disinflation trend. Disinflation meaning you have year over year gains in CPI, but it's falling, to the point where we're at what 2.4% last month. Now you've got this index. So again, this is a broad commodities index. Yeah, so a lot of these things are heavily weighted. Their largest allocation is going to be to oil and oil derivatives like gasoline, but they still are going to have copper, your other base metals. They might have some gold and silver, but this again, I think we were talking about this last week, but this is where you have a high, call it inflation beta, meaning these commodity baskets are extremely sensitive to inflation. They perform extremely well during periods of rising inflation, and you've got this index now, this massive multi-year base, and it's starting. It looks like it wants to start to break out. If it does, again, I think that speaks volumes to what is going to happen with the inflation picture down the road. And if it does, how can stocks overcome that hurdle?
They do every single time. Why would this time be any different, right?
They did it in 2022. I mean, you had rising inflation alongside, a 25% drawdown in the S&P 500. I think that's just a big risk to the outlook right now. And one other thing I was going to mention too that kind of strengthens my conviction on that call is that look at where your safe havens have been trading here recently, especially late last week. You had the Swiss franc against the dollar close to making a 14-year high, close to breaking out over an important level. You had gold close a weekly close at 3,400. That's the highest level ever. But treasuries, your other safe haven asset, U.S. treasuries aren't really doing anything. Especially long bonds. I was looking at the 30-year yield, and you're still right below that 5% level. So I mean, with everything going on, you still can't really get a bid. It seems like in the treasury market and longer term bonds. And again, another reason I'm bringing that up is because bonds are one of the worst performing things in a rising inflation environment. So it's like there's all the it makes sense that safe havens should be getting a bid right now, but treasuries can't move, and we're talking about the inflation outlook. To me, that's just another way the market's telling you that you've got inflation coming down the road.
Yeah. The other thing with bonds is once they once they kind of mature this year, is the rest of the world gonna roll their positions over and keep buying? I kind of doubt it. I think the trend is going in the opposite way, where they're not going to keep buying our bonds, and I think that could push interest rates higher on the long end of the curve. That's how I'm positioned anyway, trying to short that 30-year.
Yeah, I mean, again, I think that's probably the right trade to make right here. You've seen just a mild pullback off that 5% level on the 30-year yield, and given what the franc is doing, given what gold is doing, you would expect treasuries to get more of a bid, and they haven't. And so I think that tells you that the bearish play is the right play. But what do you think about? I know you follow gold closely. What do you think about gold right here? I mean, every time gold is making a new high, I'm sitting here thinking to myself, can it really sustain this move? Can there really be much gas left in the tank behind this move in gold prices?
Yeah, so long term, obviously, I think, I've been talking about gold with Larry for just buying, and him and I debate that all the time. I think gold is going to surprise a lot of people to the upside. You have decades regimes where gold is going to trend very hard in one direction or the other. So from like 2000 until 2012, gold went up 550%, something like that. That's a big move, and the trend in gold all throughout those years was pretty clean to the upside. Then you had about a 5 year stretch where people were afraid of deflation and gold would trend down for about 5 years. Trump got elected, it started to go straight up again, and now it's going straight up. So I wouldn't fight this trend. I think it's an opportunity every single time it dips. I think people should think, okay, do I add a little gold? Do I buy gold? As long as you're on the right side of what the central banks are doing, I think you're going to be good. So yeah, I think now in the short term you have war headlines that um, maybe you can expect some sort of retracement to the downside if everything works out okay. I'm watching oil in conjunction with gold, so like oil drops, I don't really want to be in gold, for the short term. But that's just trading. That's
You're saying
different
there's a
than
good. You're saying that is that a good correlation for people to watch? Is there a gold oil correlation?
yeah, for right now. Just for right now. That's gonna break and become completely irrelevant soon. But for right now, yeah, I would
Okay.
watch that. And usually oil goes up. I'm a believer that when oil goes up, it tends to push interest rates higher as well. So I would look for that. Oil's been up right now, kind of stuck at 72, and down from the open last night. We'll see, but yeah, I would be looking at oil as a cue for like the way that people look at the VIX. I would almost be looking at oil like that right now.
Okay, interesting. I want to stay on gold for just a second too, because we had a. I know Larry had a question come in. He was recording or he was doing his Ask Me Anything
Hmm.
session, and there was a question that's maybe up your alley, and it was about what are the odds of the U.S. revaluing its gold reserves, and what would the impact of that be? And I don't know if you understand what that question is or have any insights as to what that means or what the impact could be there.
Well, I think if Elon Musk was still in the White House, the probability would be higher. But since he's not there, I would say less than 10% chance.
What does that just reflect, or is the U.S. I mean, is like do they hold?
Well, that would require them opening up the vaults, taking stock, looking at what they have, marking everything to market. I would assume,
Okay, so
right?
that ultimately that's what that means is that it looks like so what the question implies, what it sounds like is the U.S. holds gold, call it on its balance sheet at the price it acquired it at versus, if they were to reflect that value at current market prices, that's kind of what we're getting at there. Is that what that means?
Yeah, I think so. I think so, but you never know. Market data connection lost. If they would revalue at current market, I mean, what do you? I'm not sure if there would be any kind of market effect whatsoever, though. Trading connection lost. I think
Yeah,
it's just yeah. I think it would, but I mean, I just never heard of them doing that or planning to do it, so
yeah.
I'm not sure.
I mean, I don't. That's not really anything that would necessarily impact gold prices, and I mean, I don't know what kind of unrealized gain the U.S. might be sitting on at the moment, but it's hard to imagine any potential unrealized gain being enough to put a dent in really anything when it comes to when it comes to current debt levels that are at 36 trillion or whatever deficit spending that's at whatever we're expected to run out this year, between 1 and 2 trillion. So yeah, I mean that would have you want to need probably gold prices to go up a lot more for a revaluation to have any sort of significant impact there. I would assume.
Yeah, we're sitting here talking about gold and oil, and meanwhile, Circle, that IPO, right? Yeah, you heard of it. Circle, things up another 10% today. And I'm just like thinking, God, I wish I had that retail trading mentality where I could just buy it and keep buying it regardless, of what's going on in the market. And, this thing is up another 10%. I'm just looking at all these stocks before the bell this morning. Just looks like all the high beta stuff is ripping, absolutely ripping this morning.
Yeah, I mean that's been a feature really over the past month, or I would say since the start of May, is that you had, like you said, a lot of these high beta names really kind of kick into high gear. I mean, we talked about Palantir before. You're talking about, it kind of speaks to risk sentiment that there's an IPO that's actually doing pretty well. We were talking about, I can't remember which Astra Labs or someone you're talking about last week. Rocket Labs. I mean, you can look at some of these space names that.
Time.
Yeah, but I mean, here's the thing. It's like you pull up some of these companies and rattle off to me what their last 4 quarters and next 4 quarters revenues are. And it's 0, 0, 0, 0, 0, 0, 0. Like, it
Come on,
just
Clint. You know that doesn't matter in the market.
it
It just
doesn't matter.
doesn't matter.
It doesn't matter until it does. It doesn't matter until it does. At some point, it
Right.
will matter. And I'm
Yeah.
surprised. I'm surprised the Circle IPO you're talking about's up 10% this morning when you've got some of the headlines that we've had over the weekend. I'm waiting for some of these names to just for that risk sentiment, the pen to just kind of prick that bubble a little bit, and you have all that come out of the market. I think that's kind of a risk here near term. If you look at 2 week returns for the S&P 500 historically, this is pretty much we're heading into the worst 2 week stretch of the entire year right here. The back half of
What
June is going to
seasonally? You
be,
mean seasonally speaking?
yeah, seasonally speaking, that the two on a 2 week stretch, the second half of June and the second half of February are basically like your two worst stretches by far of the entire year. And I'm looking at all this to just kind of line up and say, all right, are we finally going to see, a larger degree pullback in equities? I mean, just because you've got the seasonality aspects, you've got inflation concerns coming in, you've got Middle East conflict, you've got Circle IPO up 10% pre-market. Like something's got to something's got to give. Like it feels like something's got to give here. And we've kept saying that for several weeks now or a month, and it keeps going.
I used to be like, okay, well, it doesn't make sense. None of this makes sense. The stock keeps going up. There's no revenue. There's a lot of bad news out. Why is the market going up? And then I saw a quote, and I keep repeating this quote to everyone whenever we talk about things that don't make sense in the market. And I feel like when things don't make sense in the market, it's because momentum takes over and nothing else seems to matter. And the the creator of the efficient market hypothesis himself, Eugene Fama, he himself said, momentum is the biggest embarrassment to the theory of efficient markets. And that's because it shouldn't work, and yet it does all the time. And it's something that you can't really fight. And you look at you look a little deeper into it. Um, we went from the lows. Nobody understood why. Why is the market going up? Why, uh, you ask anybody, tariffs are driving things. It's all negative. And then you look, and all the economic indicators followed suit and started to surprise to the upside. All the soft data followed the market. So it's like once again, momentum takes over. You want to get away from that. And here's an interesting chart I saw from Bloomberg. It looks like momentum is back, and once again led by retail. Retail ramps up bullish talks, so you could see uh, that blue line is starting to perk up. Retail's getting excited again and getting brave. So the music is playing. We shall dance.
If the music's playing, you got to dance. That was, yeah. I mean, that was a great setup along those early April lows. I mean, because you had VIX second highest close in the last 15 years or so. You had what you're just showing, the AAII retail sentiment. Had a
Everybody was bearish out of their mind, right?
Yeah. I mean, it was a historic stretch of above 50% readings, which you I think set a record. And then you had, there's some debate around this. I know we talk about this around positioning and retail flows and whatnot, but I mean, maybe the retail investor didn't, maybe they felt bad, but they didn't really throw in the towel with their own money. Because that's the thing I hate about some of these survey indicators. It's like you go out and you ask people, are you bullish or bearish, and they can say you feel terrible about the market, but are you really selling your positions? But around those April lows, you had institutional investors. You had some of these like risk parity, where these guys target a risk budget. They got to stay within a risk budget. So when equity risk spikes higher, i.e., the VIX is going up, they have to cut positions. Those guys cut exposure to some of the lowest levels since the pandemic, really. So you had all the ingredients there, and I guess I'm just to see the rally unfold. But just where we are right now, it's just who's left to buy. I mean, it's just these the move off the lows and some of the breadth early on, some of the breadth indicators, were incredibly strong. In my opinion, that points to institutional involvement. It's like once the institutions have bought in, who can keep this thing going? Who's going to put the prior highs within grasp? Um, does retail really have that power if the institutions have finished doing their bit?
They have a lot more power than they did before COVID. I feel like they're definitely more of a power now than they used to be. Um, and I think they're not just more of a presence in the market. I think somehow they got more educated too. There's this thing better than anyone, right? All of the people that subscribe to you and to Larry and to my stuff, they're called self-directed investors, right? And they've gotten smarter and more educated, and so they've become more of a force. I don't know. I'm looking at GDP now, the Atlanta Fed number. It's just amazing to me how everybody was talking about recession. They saw the negative GDP print for the first quarter. Where do you think GDP now is, just off the top of your head? Where do you think it is right now?
Well, it's kind of cheating. I have looked at it
Yeah,
recently,
yeah,
but
don't cheat. Oh, you don't know.
no, I mean I've looked at it over the last time I looked at it. I mean it's running around like 4%.
Yeah, it's incredible, right? 4%.
Here, all right. So let's talk about that. So because this ties back to kind of the AEI thing too. Survey-based indicators versus the hard data. So around tariffs, call it the survey-based stuff. Call it soft economic data. The hard economic data is how things are actually coming in. The soft data went to crap around the tariff headlines. Consumer confidence plunged. CEO confidence plunged. You had these ISM manufacturing surveys. They're going out talking to purchasing managers for manufacturing and service sector firms. Those things pulled back, and you haven't seen it show up as much in the hard data. But are we going to get to that point? I mean, the GDP report. The only reason why GDP was negative during the first quarter was because there was a massive pre-buy of imports ahead of expected tariffs. And so the way the GDP calculation works is that net imports count against GDP. So that's the only reason it went negative, and that's probably a huge reason why now you got that effect coming off. That's a huge reason why it's standing at 4% right now. But you're like
The
you're
snap.
I
It's
could
this. Basically you're calling this kind of an exercise in accounting
it,
on
yeah. I mean, it's just the
it's like
GDP
accrual
reports.
accounting versus cash accounting.
Yeah, the GDP report's going to be so noisy. I don't think you can really put any stock in that, so to speak. It's because the first quarter was an anomaly, and this quarter is going to be an anomaly. So I think you got to watch. I think you got to watch as much as you can indicators of the labor market, which on one hand that's probably not the best thing to do because it's such a lagging indicator, but there are things you can watch that are more coincident in real time, like jobless claims. So jobless claims haven't budged a ton, but continuing claims are starting to creep up a little bit more. And by the way, no one really seems to be talking about the last payrolls report that we had, where it was everything's fine. We created 139,000 jobs during the month. Well, guess what? There's two reports within that report. There's the survey of businesses, which gets reflected in the figure you always hear about. That 139,000 jobs created during the month. That came from the survey of businesses. There is another survey in there called the household survey, and that's actually the one used to calculate the unemployment rate. The household survey, there were like close to 700,000 jobs lost during the month of May. And that came on the heels, too, of that ADP report that showed there were 37,000 jobs created, which was like the lowest level in a couple of years. So, I mean, there's so much variability and volatility in some of these numbers. But, I mean, if you look at the weight of the evidence and you say, okay, ADP was weak, the household survey sucked, continuing claims are starting to tick up. Like, is the hard data finally starting to catch what we saw early on with the soft data?
I don't know, but I think this is why retail tends to outperform, because they just don't look at this stuff at all.
Tune out the
Right?
noise.
They don't look at this at all, and maybe that's their edge. We dive into these fake numbers that come out from the government. You cited very well, by the way, all of these nuances in how they're calculated. And I don't think they're meaningful. I think the trend is meaningful, but I think these one-off numbers are completely irrelevant. And that's why you see the price reactions on these economic indicators. They tend to revert. Anybody that trades the 8:30 numbers, the CPI numbers, or the jobs report numbers that come out at 8:30, or the ISM numbers that tend to come out at 10 a.m., or the Fed, any of these economic news, like it's like a blueprint. You wait for the reaction, the algos do what they do, they jam things up or down, and then you look for an opportunity to go the other way, because all of this stuff is either priced into the market, or just completely irrelevant, where any algorithmic reaction tends to get reverted.
Yeah, you want to trade the reaction to the reaction is what you're saying.
Exactly. That's exactly it.
Yeah.
That's right. So it's 9:07. We have a straddle at around 28 points on the S&P 500 pre-open. 28 points. What do you think of that?
I think I'm surprised it's that low. And it was low going into Thursday or Friday last week, and it was just you're thinking to yourself, why, with everything going on, it's just amazing that there's not much volatility being priced into this market right now. You're not getting paid much to take on the risk when it's at those levels.
28 points. Everything seems fine. Maybe everything is fine, right? Why question it? The futures are basically maybe, I don't know, 10, 15 points away from Friday's high in the future session. That, I mean, if it breaks Friday's high, would you follow that momentum to the upside, or
To the
would you?
upside, no,
Yeah.
I would probably look for a reversal trade at that point. Maybe look for some momentum divergences.
You've been hanging
I,
out with Larry too much.
you know what? I more often than not, I like to trade with the trend. I think there's a lot of things near term stacked up against the market right now, and I would be looking for that reversal trade. But I do agree with you. If I am going long something, I like names and linked to the energy markets right now. We're talking about energy stocks, kind of maybe the longer term outlook earlier. In the natural gas space, I didn't mention them, but I like some of the producers here. Some of the more traditional exploration and production names. I think near term, maybe look at like a Range Resources, Antero Resources, or maybe even a EQT, which I believe they're the largest nat gas producer in the U.S. You talk about things breaking out to new highs. Well, I think each of those names are setting up just below their 2022 highs, basically your last big run in commodity prices. So, if the broader market is starting to make a new high. I'm probably trying to fade that. But if some of these energy producers are, that's momentum I want to try to ride to the upside.
Okay, got it.
Long
I think
natural gas, short S&P 500. There you go.
you know it's an interesting play. It was working last night. It didn't work. I had to get out of one of the legs, but I was thinking to just be long the S&P futures and have a gold position together. As a combination. They've seemed to be pretty uncorrelated, and I just think that that's probably something that I'd be looking to trade.
To me, that sounds like a long inflation trade.
That's right. That's right. That's what it is. But with upside to equities. So kind of thinking along those lines. Are you guys putting on any? Have you put on any new currency positions?
We thought about it late last week, and then we probably should have, but we had the reversal. We're kind of eyeing in the euro, but things just kind of went haywire after the Middle East headlines started coming out, and now it's just we're settling in, letting that volatility go down, and looking for kind of that next directional play. So not yet, but we're anticipating having something there soon.
All right. Straddles at 28. Market is right under Friday's high. A lot of bad news out there. The market isn't trading like it. So
Climb
let's
the
see how
wall,
the rest.
Lori.
Yeah, let's see how the rest of the day works out. Join us again tomorrow. Clint and I will be here. Larry won't be joining us. Is that correct?
I believe that's correct.
All right. So I'll see you tomorrow, Clint.
All right, sounds good.